But the current Fed is cutting rates, is going to cut rates more in 2025. So gold is just getting started. This is at 1979. This is 1971. So gold is going to rise multiples of its current price. Well, I think we're just getting started. I mean, gold is up almost 30% so far this year, and another, all-time record high today, getting close to 2,700 in the spot market. This is the best year that gold has had since 1979. That is not insignificant, but also a key difference between now and 1979. That was the end of the gold bull market. And in 1980, Paul Volcker raised interest rates up to 20%. That's what killed the bull and brought inflation down. But the current Fed is cutting rates, is going to cut rates more in 2025. So gold is just getting started. This is at 1979. This is 1971. So gold is going to rise multiples of its current price. Just like earlier in this century, gold started in 2001, was $270 an ounce, and it had a 10-year rise to $1,900 in 2011. Then it went sideways for about a dozen years, 13 years. Now it just broke out this year, and I think we're going to see a move as big as that earlier move, and that was a six-fold increase in gold over 10 years.
Wow. So am I crazy here? Or are you telling me that gold's going to be worth like 6K or something? When you say multiples, what are we talking and when?
A lot more. Yeah, no. If gold goes up six-fold from here, that's
right.
Close to $20,000 an ounce. And it's not that gold is getting more expensive. Remember, when we first started our country in 1789, gold was $20 an ounce, and it was still $20 an ounce in 1913, over 120 years later, when we established the Federal Reserve. But now you can't buy an ounce of gold for $20. You need almost $2,700. It's the same ounce of gold. All that's changed is the value of the dollars that the Federal Reserve creates. Well, the dollar is about to collapse. In fact, it's almost near a new 52-week low here again today. If you look at the dollar index, it's near a 13-year low against the Swiss franc. It's going to hit a record low against the Swiss franc next year. But I think next year the bottom is going to fall out of the dollar, and that's going to really unleash a bigger move up in the price of gold. But again, it's not gold becoming more valuable. It's the dollars that they're printing becoming less valuable.
Okay. Dollar right now still sitting at a range that's been in for the last 2 years. We're at the low of that range, $100. So it's softened up to your point. But hasn't there been a major disconnect between gold and real yields? I mean, this is a really big deal over the last 6 months because the relationship that's usually quite reliable. Real yields go up, kind of generally yields go up, and then gold comes down. As the Fed's been cutting, we've kind of had a pretty major disconnect. What explains that gap, Peter, that change in the relationship?
Well, the Fed is very desperate. I mean, normally they wait until there's a problem before cutting rates. They wait for, major stock market decline. They wait for a recession. But here, they're cutting rates even before we're officially in a recession, and with the stock market at all-time record highs, with real estate prices at all-time record highs, and with the gold price at an all-time record highs. We've never had the Fed start cutting rates when gold was at an all-time record high. And in fact, the record high in gold proves that the Fed's rate cut was a mistake. It proves that the Fed is too loose. In fact, they never achieved a restrictive policy. They keep talking about that, but they never really got restrictive because credit kept expanding. We have record amounts of debt, government debt, corporate debt, household debt, credit card debt. Nobody stopped borrowing, and we have record low savings. So that shows that the Fed never raised interest rates high enough to break inflation, and now they're cutting them prematurely. And so gold is telling you that we're going to see a spike in the CPI big time, I think, in 2025. We've seen the lows in inflation. 3% is about as low as it's going. Now it's heading back up to 9% and then higher. And I think one of the big drivers next year is going to be oil, because right now oil is the lowest it's ever been in history. Mm-hmm. You can buy 40 barrels of oil with 1 ounce of gold. Outside of like a few weeks during COVID, that's never happened. So oil is super cheap right now, but it's not going to stay cheap. It's going to, after the election next year, oil is going to go up, commodities are going to boom, and the Fed is going to be in a real box along with the economy because inflation is going to be breaking out at the same time the economy is breaking down. So we're going to go into a recession with rising unemployment, but we're also going to have accelerating inflation. And so what's the Fed going to do in that circumstance?
Okay. Well, right now we've had disinflation. Yes, not deflation. Obviously, we've come down really hard. And to your point, economy has slowed down here. But we've also continued to hold in. I mean, to your point, debt to GDP is still off the highs. I mean, it boomed during COVID, but like in the last year, it's plateaued to drop. So what I'm trying to drive is it seems like there's another thing here that's going on for gold. Is it geopolitics? Is it the central bank stuff? There still seems to be a part of the equation that's missing, Peter, because some of those things you're talking about have cooled off. Debt to GDP's come down.
No, they haven't. If you look at the way the national debt is rising right now, it's rising about $3 to $4 trillion every year. Interest on the national debt is over $1 trillion a year. It's now more expensive than defense. In a couple of years, we're going to be paying $2 trillion a year in interest on the debt. It's going to be a bigger expense than Medicare or Social Security. And so the fiscal solvency of the United States is rapidly breaking down. People are losing confidence in the dollar. They're losing confidence in the creditworthiness of the United States, our ability to service this debt. We have no ability to repay it. And so the dollar is going to be marked down, and I think the world is going to be divesting of treasuries. That's why you're already seeing yields on the 10-year to the 30-year are higher now slightly than they were when the Fed started cutting rates. And I think that's going to continue. In fact, I think that by the first quarter of next year, and maybe even before the end of this year, the Fed is going to return to quantitative easing because the yield on the 10-year Treasury is going to break above 4% again and head higher. And I think the Fed is going to panic at that point and relaunch quantitative easing.
Peter, why would they panic at 4% if they didn't panic at 5%? Like, what's the big deal about us going to 4%? We were at 5% a year ago.
When we were at 5% and the economy still looked like it was growing, the Fed was still saying, okay, we got to fight inflation. But what happened is at 5%, banks started to fail. You had a bunch of big bankruptcies in basically an insolvent banking sector, and the Fed stopped hiking rates.
You're talking about the regional banks?
Yeah, you Silicon Valley Bank, Signature Bank,
right.
but a lot more banks would have failed if they didn't get backstopped. But that's really why the Fed stopped hiking. It wasn't that they won the fight against inflation, just that the collateral damage was becoming too great,
Peter,
and so they backed away.
You told me about the banks last time, about insolvency of banks. So the stocks of the big banks are doing great. They assumed all of the weaker, the smaller ones, the ones that were over-levered and exposed to all this Silicon Valley froth that blew up. I mean, yeah, those definitely blew up 100%. But the stock market's been telling you the other big banks have actually been great the last 6 months.
The financials haven't been doing that well recently. And you remember, a lot of people were oblivious to... A lot of people were oblivious to the problems in the financials up to the 2008 financial crisis. I mean, people were recommending all these stocks right before they collapsed and had to be bailed out by the government. Look, I think they have a lot of toxic loans on their books. I think the commercial mortgage loans are going to collapse. I think banks are losing money on all the residential mortgages that they own because they're collecting such low rates on them. And rates are going to go up with inflation. That is the problem, right? Inflation is bottomed, that is headed higher. And the reason that the economy was able to handle the 5% rates for a while was because everybody knew the Fed was going to cut, and it was only temporary. But when inflation comes back, and now the Fed is in a predicament where it actually has to start raising rates again, even though the economy is in recession, and that people are going to realize that they're never going to get back to these super low rates because long-term interest rates stayed low. Look where the yield is on a 10-year Treasury. It's still below 4%. And look at the tip spreads. For the last 4 years, the break-evens on tips have been close to 2%. I mean, right now, the break-even is 2.12. The markets still don't realize how much inflation we're going to have over the next 10, 20, 30 years. It's not going to be anywhere near 2%. It's more likely to be 10% or higher. And so the whole bond curve has to reprice to reality. Because for the last several years, bond investors have been completely asleep, oblivious to the inflation that's there. They're going to wake up from their slumber, and this is going to be a whole new world.
So give me a projection. We got 30 seconds. You say 10-year 4% first. I mean, that was like a couple weeks ago. If this big inflation roar is coming back, where do we get rates then in the next 12 months, Peter?
Where do we what?
Where do we get rates in the next 12 months if you think there's another big bond blow up and inflation scare coming?
Well, I think the Fed is going to keep cutting. The Fed is going to keep cutting for a while, but the market's going to keep increasing long-term rates as the Fed is reducing short-term rates.
Yeah, where to? You think we get back to 5 for the 10-year?
Well, I think we're going to ultimately get a lot higher than 5. But I think before we get to 5, the Fed's going to go back to QE, and that will temporarily slow down the rise of yields, but it's going to accelerate inflation. And it's ultimately going to put more market pressure to move interest rates higher, particularly once you get away from treasuries. So corporate bonds, municipal bonds, whatever the Fed isn't buying, the prices are going to collapse and yields are going to go up, as we're in this stagflationary environment. And there's also, political ramifications too, depending on the outcome of the election. But I think it's bad either way fiscally. But I think we're finally getting close to the day of reckoning. That's what the gold price is telling you. The GDP is consumers spending borrowed money to buy more expensive groceries and stuff like that. It's the government spending borrowed money is a big part of that GDP. And we have a massive deficit that is a consequence of this fake GDP growth. In the meantime, our current account deficits are at record highs. Our trade deficits are at record highs. The economy is hemorrhaging red ink. We do not have a good economy. We don't have a growing economy. We have inflation. And inflation creates the illusion of economic growth, but people are getting poorer even though the numbers are going up. Again, look at the price of gold.